All right, welcome back to the Cow Guy Close. I'm Scott Shelly, otherwise known as the Cow Guy. I think it's a black and white jacket. We'll go with that. All right. It's been a rough start to the year, folks. Going into the last day of the month this morning, the Dow was off roughly 4.5%, S&P roughly 7%, and that tech-heavy NASDAQ down 12%. Is this going to be a continuing trend this year for investors, or will this subside as the year goes on? I don't know. My next guest definitely has some thoughts. Please welcome to the show Rebecca Walser from Walser Wealth. Rebecca, I mean, it's a toughie, and nobody's got a crystal ball. I got that, but I just really want your opinion and your expertise and your longevity. What do you think is going to happen?
You know, Scott, I would say that this is a good sign that the market is up today, but also, it's pretty reactionary to the fact that the Fed last week said that we weren't going to see any hikes until March. And, everyone's speculating, is it going to be 2? Is it going to be 4? Is it going to be 7 or 8? As some economists say, Bank of America saying 7 last week. So, I think the market is happy and sort of, it's like something's imminent and coming, but it's not there yet. So you're relaxed and you're just taking a break. It's like being in labor. Okay. That's a great analogy. You're in labor, the next contraction is coming, you're not ready to deliver, and so you can take a pause in between the contractions, right? And that's what's happening with this market. We know a market contraction will follow not only the rate hikes that are due to start in March, but also the runoff. We're going from stimulus to runoff, and that is the other biggest part that people aren't really addressing. When you go from a stimulus environment to not only you retract all the stimulus, but you suck back in the money supply by running off your balance sheet, that's another problem for these markets. So I think people are enjoying the buying of the dip. Maybe they think they might have a little bit of a runway still before we start to see the impact for March, but it will come, Scott. It will definitely come.
All right, I've got a couple of things. Number one, I wasn't really going with the pregnancy idea. I was more in the camp of substitute teacher today, but test with a regular teacher on Friday, right? That's kind of what I was thinking.
All right, I like that.
I want to also talk to you about operationally, if Bank of America is going for 7 hikes, how does that happen? I mean, how are they? What are their expectations there?
I don't see the logistics of how it happens. I think a lot people are really expecting earnings this week. We have 108 S&P 500 companies reporting. It's interesting now that we have Facebook, right? So do I say Facebook or do I say Meta? I don't know, because I say Alphabet and I also say Google. So Facebook had to join Alphabet and give us 2 names to say. So we've got Google this week, Facebook this week, Amazon this week. We've got a lot of big players this week. So we'll start to see earnings season for last year, how well we did. Most 80% of the companies so far have about a 5% beat. We're expecting earnings to still be good, Scott, but 7 rate hikes is astronomical, and I think it's way too aggressive. I think that the Fed can't hyper correct what they overstimulated. That would just cause hyper problems. So we need to raise rates. We need to pull back and run off the balance sheet. I get all that. It makes sense. We overstimulated. I've been saying that. We almost had a straight line up on the S&P 500. That is indicative of an inflationary bubble. So we need to get this market back to where it really should be, but let's kind of try to do it slowly if possible. Fed, let's not just, let's just not bury this market because we can't absorb 7, Scott. Let's get real.
Yeah, I agree. And usually when the wheels start to fall off because they're trying to do quote unquote the right thing, they stop doing the right thing. And that's a problem too, right?
Exactly, yeah.
So talk to me about this. This is one of my things, I lay awake and I think about the worst case scenario, which makes me have no friends. But my concern is the inflation problem that they're going to try to surgically remove without hurting the economy, which I think the market's telling us that they can't do that. That's a high, I'm going to bet against that, and I agree. But food and fuel are such a large part of that inflation problem.
Yeah.
What happens if they're raising rates at a quarter at a time into the teeth of $100 oil, and we sit here and talk about commodities all day and see these food prices rallying because of the input prices that are there's a chance that some of these rate hikes could be, canceled out by just higher food and higher fuel.
That is the other part of this whole equation. What is going on with the supply chain problems? And where's Pete Buttigieg? He's talking about installing speeding cameras across the interstates of America. He's dealing with that problem because he wants to get to 0 fatalities. He literally said we want to get to 0 fatalities. Where are the conversations coming from him about the supply chain problems? Where is he addressing the empty stores that we're already seeing because China shut down plants and we still have ships sitting off of California? Where are these discussions? I don't really care about a national speed trap right now. I want to talk about supply chain because that's the other inflationary pressure that we have. If you have energy disruption in the market, whether it's at the refining stage, whether it's at the delivery stage, whatever stage it's at, we all know, Scott, that impacts future oil production, and that impacts energy prices almost immediately. Same thing with food. If we know that there's going to be a shortage, then these are our last, full shelves that we're looking at on the screen right here. People are going to go and buy that stuff up. It's going to be empty, and we're not going to get, resupplied on a normal schedule. So where are the conversations from this administration about that? Because it's not just all up to the Fed. The Fed may have overstimulated, but they didn't create this whole problem in a vacuum. There are other pieces of our government that need to take charge here and get us real solutions, and let's address them, and they're just not.
I mean, this is going to be the stat that really shocked me. It's one of the two biggest stats I've ever heard, but, since the inception of this country, maybe I said this the last time we were on the show, since America was born, roughly 30% of all the dollars floating around out there have been printed within the last 2 years. I mean, that gives me goosebumps. That's a shockingly high number. I mean, that's like that ball of stone rolling down the hill towards, Harrison Ford and Raiders of the Lost Ark. But once that ball's rolling, that's going to be hard to stop. And that's a lot of money out there.
And Scott, I know we probably don't want to go into this deep of a topic, but you've got the repo market too, and you've got $11 trillion that was paid to the banks in 2019 that was really under the radar. The Wall Street Journal did a really great analysis, multi-part analysis of that in December of this past year. So we have got a lot of stuff going on with the Fed that is just shocking. And unfortunately, and I don't want to be a pessimist, I'm not a sky is falling person. I'm usually the optimist and what's half full and not half empty. But let me just tell, our long-term investors out there that really, Scott, can't afford to see this market go down. They really need to seriously consider taking some profits and maybe sitting on the sidelines for a few months, because I think it's going to get really, really rough out there.
It's hard to argue with that. And the last thing I want to talk to you about next time you're on, let's talk about that yield curve. That 2s, 10s coming in as sharp as it has too has got me a little bit nervous too. All right. Thank you very much, Rebecca Walser from Walser Wealth. That's fantastic stuff. Love having you on the show. All right. When I'm looking at the markets, I have my go-tos. Some of them are a little out of date, but we're still going to go over them. That's the gold, the oil, 10-year, and the U.S. dollar. Let's take a look at them. Gold has had its luster taken away by Bitcoin. We can bring that up too, but gold's up about $12 here today, around that $1,800 level, which is not shocking. Look at Bitcoin on its way back, 38,750 last, really, close to the highs of the day there. So that's getting a little bit comfortable. Crude oil market, up $1.21, making a move towards that $90 level. 88.03 is last. And let's take a look at what the U.S. dollar is doing. It's come off here a little bit. That's significantly below that 97 level, 96.5, but still stronger than it has been as of late. And the last thing we need to see is what the 10-year yield is doing today, and that's pretty much a whole lot of nothing. So the markets are a little comfortable on the last day of the month with a little bit of a rebound on these equity markets. It's been an interesting one, to say the least. All right, coming up, what do ag producers need to keep in mind as all the noise infiltrates in from the financial markets? Chris Robinson joins the show after the break to share some insights. You're watching the Cow Guy Close on RFD TV. We're going to be right back.